And this is why I always say, look, the answer is to stack. Don't try and trade it. You get killed if you try and trade it. And you'll find yourself out of silver with the price far higher. And you'll be regretting the fact that you took some sort of short-term profit, or worse, and quite likely, you were spooked by the fall in silver as other retail investors, rush for the exit. I mean, the answer is to just sort of understand what is actually happening. Now, what is actually happening is that we're coming to the end of the fiat currency system that has been in place since 1971 in naked form, and you could argue in, if you like, shadow form all the way from 1933, when the Americans in particular were banned from owning gold. They had to submit their gold in return for dollars, and the next year there was a 40% devaluation by Roosevelt's government. So the answer basically is just protect yourself. Protect yourself from a credit crisis, which is what currencies are, by owning gold and silver. I mean, if you look at what's been going on in silver, there is no doubt that there has been huge retail demand, not in the West, but in Asia in particular. There is, if you like, the sort of psychology among people who are late to the gold game, particularly in the retail side, if you like, the smaller players, the people who, let us say, have a few $1,000s to invest, to take the view, well, gold has risen and I want to go and, I want to buy gold, but it's already gone. Perhaps I should buy silver because it's a lot cheaper. Now, I mean, the psychology, if you like, leads in a sense to flawed logic. But nonetheless, you can understand that this is the motivation for buying silver. And in particular, we have seen, I think, speculative froth, if you like, in China and to a lesser extent India. But I mean, we can particularly record it in China. Basically, on the Shanghai Futures Exchange, they have increased the margin requirements very substantially, as they have in COMEX. Now, there's no speculation worth mentioning at all in Western markets, so we can dismiss that. It's almost entirely in the Asian markets. Now, when you have demand effectively dominated by retail buyers, as it were, then you're going to get volatility in the price. It's as simple as that. Because I mean, you could take the view that the nasty big boys basically want to shake out the poor little punters, or you could say that the retail trade is more susceptible, if you like, to swings in emotion than, let's say, industrial buyers, industrial demand, or serious hoarders. And I think that's probably the real reason there's been so much volatility in silver.
MacLeod says, stop watching silver prices. The volatility is Asian retail stack and ignore fiat is ending. All commodities are cheap in gold. China could put yuan on a silver standard. Central banks hoard gold. Be your own central bank. Hold physical outside the system.
But in China, they were on a silver standard as recently as 1935.
Right.
And so, this is something which Asian individuals, and we're talking about, I don't know, 3-4 trillion out of billion out of a global population of what, sort of 7.5, verging on 8 billion souls. This is the majority of the world's population, more or less, have this experience, not necessarily their own, but the experience of their fathers and their grandfathers. So there is this affinity with silver as money, which is far, far greater for Asians. India, China, I mean, these are two mega nations. I mean, between the two, you've got roughly 3 billion souls, which is what, 40% of the world's population, just in those two nations. For them, silver is money. And they're not fazed by the volatility. I mean, in Singapore, they're still queuing around the block to buy silver, and gold as well. But, so the idea that, this is a flash in the pan and it's all over and all the rest of it, I mean, forget it. This is something which, if you sell your silver, and I don't care what happens to the price in the short term, you will regret it, because the fundamental factor behind all this is a collapse in the value of credit. And it doesn't necessarily start with bank credit in the sense of your bank deposits and all the rest of it, but it is certainly the case in the superior levels of credit, which are the currencies themselves. I think this is a fundamentally different situation. I mean, there have been times in the past when we have worried about the stability of currencies. But this is the real deal this time. This is the end of the fiat currencies. So actually, you should be not thinking in terms of what is the price of silver measured in dollars, Aussie dollars, US dollars, sterling, whatever. You shouldn't be thinking like that. You should be thinking about, at least I'm out of, collapsing credit. In other words, you've got to stand your mind upside down in terms of understanding prices. God help us. I just cannot see how we're going to get out of this. Now, the point about me, the point I'm making is that unless someone just arises from somewhere who can actually deal with this problem, and as I've just said, this appears at the moment to be so unlikely, then the purchasing power of these currencies will go to zero.
Yep.
So what does that mean for the price of gold, silver? What does it mean for the price of anything? I mean, a cup of tea would be unaffordable to most people, let alone what is the value of gold measured in these rubbish currencies. So that is what you've got to bear in mind. The reason in which you hold physical gold and physical silver is against this sort of financial Armageddon, which is not 100% certain, but it's looking like 90 to 95% certain. Yeah. And quite frankly, if it doesn't happen, we should all rejoice.
Yes.
But at the moment, I just cannot see the circumstances where this collapse is not going to happen. And I think that's what you've got to bear in mind. Don't look at prices, a waste of time. The value of gold, for example, and the value, I mean, silver is volatile, obviously, but the value of gold basically is the same today as it is tomorrow, as it does the day after. What's actually fluctuating is the value of fiat currency. That is where the danger actually lies. Now, if they don't do that, then it's quite clear what happens. And you've got the German 1920s example, if you like, which was the best documented collapse in a currency that we still have, really. And you have that, if you like, as a sort of as a warning as to exactly what happens unless the politicians turn round and address these fundamental factors. Now, what's the likelihood of that? Zero. I'll tell you why. Because they're driven not by economic considerations, they're driven by political considerations. And no voter, no member of the electorate is prepared to support a politician who's going to ask them to make the sacrifices which would be required. It's just not on. I mean, the thing that was fascinating about the collapse of the Reichsmark back in between 1920 and 1923 was it was overseen by an economy minister who was a well-known and respected economist. We don't even have that today. That China is likely to follow a similar course with what she has put in place. And what I mean by that is that she has accumulated huge amounts of gold off balance sheet, as it were. It's certainly not on the reserves of the People's Bank. She can declare what she's got at any time, and my guess is that if she was driven to declare her true reserves, she would say something between 30 and 40,000 tons. Now, this is multiples of what the US claims it has, and is reluctant to prove that it actually has in Fort Knox. So the rest of it. So, I mean, if China did do that, it would actually be, if you like, the end game, particularly for the fiat currencies, not tied either to gold or to a credible gold substitute, which at that stage would probably be the yuan, or even possibly the ruble, because again, the situation in Russia is that they could go on a gold standard quite easily. And indeed, there's big arguments why they should, because with interest rates running at sort of 14, 15%, once the gold standard is established, you would find that rates would sink down to around about 4%, 3%, and be non-inflationary. So there is motivation, I think, to do that. Now, given that central banks don't want to actually part with the gold, but want it, if you like, in the shop window, not rather like Rolexes. I don't know if you ever go on. I mean, I don't buy fancy watches, but if you go into a store and try, it says that Rolex in the window, I'd like to buy it. Oh, you can't have it. There's a waiting list, 2.5 years. I think that basically is the central banker's approach to gold, if you like. So what would China do? No, China has very, very strict exchange controls, which basically means that you've got two yuan. You've got an offshore yuan, which can trade freely, as it were, be exchanged freely. And you've got a domestic yuan, which can't leave the country. I mean, well, it can, but you've got to have a very, very special case, and it's got to be authorized by the People's Bank, and so on and so forth. So given that you've got these two pools, and given something else, and that is that all the indications are that China has actually accumulated substantial silver reserves, again, off balance sheet, if you like. Because they have been importing doré, they've been importing non-ferrous ores, refining those. They are the second largest silver mining nation, but also it would require a gold-silver ratio which would be more in line with the levels set famously by Sir Isaac Newton back in the early 1700s. So, we will be looking at somewhere, I think, to give it a broad range, between 12 and 20 times, the gold-silver ratio being 12 and 20 times. But the point is that with the domestic yuan being in a completely separate pool from the international yuan, it would be theoretically possible anyway for China to turn round and say to holders of the domestic yuan that we can exchange, we can fix that to the price of silver. Now, again, they would probably want a mechanism to restrict the public's demand for silver, but actually that would settle down after a while. What we can do is we can give you an exchange rate against silver, so that it gets fixed against silver. While you can't have the one that's backed by gold, which is for international trade settlement only, if you see what I mean. Now, what it would require is not only substantial control over gold and silver markets. For goodness sake, what China did then basically was it just said, right, okay, you're not getting our rare earths, tough. But very strict controls over it. Now, what we didn't know at the time, but has become obvious later, is that this rare earths policy wasn't restricted to rare earths. It was also extended to silver. Because at the same time, America turned round, totally independently of Trump's art of the deal, and decided that silver is a critical mineral. Now, so far as we know, America disposed of all its silver stocks, its strategic stocks, a long, long time ago. It hasn't got any. Now it says it's a critical mineral. So from China's point of view, supplying silver to the West is basically supplying silver to the Americans so that they can rebuild their stocks. Are we going to do that? Are we? Hell is like. And I mean, that was that policy, the rare earths policy, which, sorry, excuse me, as I say, appears to have been extended to silver at that time, was in late September. By October the 9th, in other words, within 2 weeks, there was a delivery crisis on the LBMA.
Yeah.
40% rates, suspension of trading for an hour and a half while, the mess was sorted out, etc., etc., etc. And it was really from that point that silver really took off. And
very true.
Are the Chinese going to come back? I say, oh, terribly sorry. You can have some silver after all. I think it's quite unlikely. I mean, there is individual volatility, yes, but if you look at a broad basket of these, and even sort of a basket of base metals and a basket of agri-products and a basket of energy, for example, you will see that they're all very, very cheap measured in gold. Now, to some extent, you could argue that this is a reflection of the gold price having risen, measured in fiat currencies. That is undoubtedly true. But the rise in the gold price is actually giving us a message. It is looking forward, if you like, into what the purchasing power of fiat currencies will be, let us say, in 3 to 6 months, or maybe even a little longer. So what we're saying is that it's not just gold, which is cheap, but it is in the context of a collapsing fiat currency environment, but also all commodities are cheap measured against gold. And this has led to distortions in markets as this begins to unravel. And we've seen this particularly in silver, platinum group metals as well, and a few other things. We're beginning to see it in copper, for example. Now, that's a very, very important commodity. Now, friends of mine in the copper industry say, well, look, there's plenty of copper around. We just don't understand what the hell's going on. Well, yeah, sure, there is plenty of copper around. But it's not copper that matters. It's the medium in which you price it.